You're listening to the Wealth Mindset Show, where Hixon Zuercher Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey. Welcome back to the Wealth Mindset Show, where the Hixon Zuercher team helps you manage wealth, navigate retirement, and make smart decisions for a secure, meaningful future. I'm Austin Wilson.
Chief Investment Officer.
Chief Investment Officer. I did not mean
New
to.
title.
Yeah.
Well, that's all right.
Hixon Zuercher Capital Management.
It's new to you.
Yeah.
Starting this year.
It is.
And I'm Josh Robb, Director of Wealth Management at Hixon Zuercher Capital Management. Still there. Still doing that.
Same guy.
So, but yeah, that's a big announcement.
Yeah.
I mean, we are, have now officially January 1st, 2026 is when it started, but you are a partner at Hixon Zuercher Capital Management with Tony and myself. So we are glad to have you.
Yeah, I'm excited.
And we're looking forward to a lot of success in the future. So that's one big news.
Yeah.
How was Christmas, New Year's?
You know,
we're on the other end of that now.
New Year's, Christmas, it's all good. It's all for the kids, you know. You do it for the kids. Kids have a lot of fun. Kids get a lot of stuff. We have a lot of generous people in their lives.
Yep.
Minivan's been full multiple times of things that they didn't know they wanted or needed, but they got.
They have it.
So we're in the middle of purging on the other side of that to get rid of the old stuff to bring in new stuff. But
save boxes so that the kids
absolutely
could donate some things and clear up a little bit.
And now we're in the return a bunch of things that you bought and didn't need or all this other stuff phase. And I saw some statistics about how like January is crazy for returns.
Oh, I bet.
And there are startups and apps that will help you return stuff.
Oh, nice.
It's like it's like a subscription, I'm sure. Or you pay a fee
to help them
for $3 to return your $20 item. They'll return it for you. I don't know.
Yeah.
But anyway, so we're kind of in the middle of all figuring that stuff. Stuff we bought in Columbus and didn't end up needing, whatever. Like, we have to drive back to Columbus to do a return.
Yeah.
Nah, we'll sell it on Facebook Marketplace.
That works too.
But no, kids are good. Life's good. What about you?
Yeah, we there's a new thing, and a couple of our kids had a version of it, but it's so Malachi, my 11-year-old, he loves basketball. He loves whatever sports season he's in. He's currently in basketball. Yeah. So if you've ever been home and had a kid dribbling a basketball in the house, it's no fun.
No,
after a while,
rings
it just kind of
everywhere.
So they make these new things called silent basketballs.
Okay, I like
silent basketballs, which are exactly what they sound like. It is best time to describe it, a foam. Okay. And when you dribble it, it bounces like a regular basketball does for the most part. It's not the same weight, but it moves pretty close.
Yep.
Does not make that loud noise.
That's awesome.
So he can be in there and just dribble, and it's soft. It's softer, so he's not going to break things. Yeah. So he got that. And then a couple of my kids got silent volleyball. Same idea as you could bounce it off an indoor wall and it won't scuff it or mark it. It's softer and it's quiet. So that helps with the noise.
I would imagine
for sure.
so.
And so that was a big gift for one. And then it's been hanging out. We all stayed healthy, relatively, just small colds, but nothing big.
That's good.
Which is always
everything's been going around.
Yeah. Well, I guess at our kids' school, the week before Christmas, in one of the kindergarten classes, so let's say they have roughly 30 kids in their class, give or take, 4. That's how many kids were in the class, not out.
That's
how many kids were in the class. And so thankfully our kids stayed, like I said, relatively healthy through it also.
That's good.
Yeah.
Well, we are here in 2026. 2026. And if any of our listeners for a long time remember, sometimes we do prediction episodes.
Yes.
Where we say, here is what, we're wrong all the time, but here's what we think is going to happen in the next year.
Yes.
So here's what we're doing today. Josh and I have actually printed off. We've not done this on
and wrote it.
We usually do this in a shared Apple Note with our iPads, so we know what each other's going to say, or we just know the points we're going to talk about. We have an outline, and then we had to make our own predictions, and we're off
Secretly.
the grid, so we don't know what everyone's going to think. But we've got interest rate predictions, we've got market predictions, we've got asset class predictions. All of these are going to be wrong. None of these are investment recommendations.
They're just
because they're going to be wrong.
Our guesses in the future with for me at least, no basis in my prediction.
I would say there is more of a chance of these being wrong than right.
Yes.
On any given thing. But it's going to be fun, and that's going to be interesting to see what everyone thinks on. And this is a great opportunity for you as a listener. You see this episode on YouTube Facebook or wherever you see it.
Or
comment some of these. Yeah, comment on some of these things and see if you could put your predictions into, because that'd be kind of an interactive way. But we're going to start with some big picture thoughts. So this is 2026 overall, big picture, market themes. The biggest one, and this kind of shaped the way the market went in the fourth quarter specifically of 2025, was interest rates and the Fed. So, Josh, what is going to happen in 2026 from the Fed?
All right. I wrote down 1 to 2 rate cuts.
Okay.
Leaning towards 2. So that's what I wrote. So
that's your
I
guess?
think, in which is kind of where the market is, right? That's
so you went out left field there.
I'm leaning towards that the Fed will do that second rate cut.
Okay.
I'm in that camp.
Well, I wrote down 2 cuts.
Oh, okay. Not You're
I'm all as I can be right now. I think we're going to get 2 cuts. The market's in between the 1 and 2 camp. The labor market weakening is certainly what they're focusing on the most right now. But inflation's been coming in relatively light.
Yeah.
Like November inflation, the most recent one we got, 2.7%.
Mm-hmm.
That has a 2 in front of it.
Right.
And shelter costs are coming down pretty drastically. So I think you're going to get 2. And if things slow down, you might have more, but my base case is 2 cuts.
2.
If you look at overall interest rates, so think of like a treasury curve, I would say, and I'm going to get to this when we talk about fixed income, but we're going to have a steepened curve. So like the long end is going to continue to stay kind of where it is.
Okay. Not much movement.
Not a lot of movement. This is where the market's kind of having internal turmoil of, is this debt load that we're facing sustainable and all this other stuff. The short end is where the Fed is happening here. That's going to come down. So we're going to have a steepened curve.
Yep.
That's kind of what I'm thinking overall. So that brings me to my next point is inflation, Josh.
Okay. And you said 2.7.
2.7 was November.
Yep.
I actually think we're going to stay. This is kind of counter to the market. A lot of the market's predicting that some of these tariff costs are going to creep through the first half of the year. I think we're going to make a slower grind in this upper 2 range down to 2.5 by the end of the year.
2.5. Wow. Okay. I went the other direction.
Okay.
I said 3.4, which we all year long until here, we were in like 3.1.
2.9, 3.1.
Right in there. And I just think we're going to see it creep up, not like uncontrolled. It just be kind of this slow. And that's also with this rate cuts, their 2 might just stimulate a little bit of that. Again, that second one. So 3.4, not a bad.
We'll just take an average and hopefully land in the middle.
Guess what the long-term average is? 3.5.
Yeah.
So I'm just kind of hitting right along the long-term average.
Yep. So here's the next.
Markets.
This is the big one, markets. So we've had a pretty steady, take away April.
Okay.
April was its own thing.
Forget about April.
We had it was a really rough April and then not so bad. Rough couple weeks, really nice couple weeks.
Mm-hmm.
And actually April was flat, I think, or ish. But we had pretty much a bear market. Intraday, 20% bear market in April.
That was coming off all the tariffs.
Coming off all the tariff discussions,
there.
Liberation Day. But think about what we've had. We had 23. So this is coming out of the 2022 bear market. 23 was very strong.
Yep.
24 was very strong.
Yep.
25 was very strong, despite having a bear market in the beginning of it.
Mm-hmm.
What does 2026 hold? And my
you go.
thought is volatility is to be expected. I think we will have a 10% correction for the S&P 500 at some point during the year. It just seems like where valuations are, where uncertainty is around the adoption rate and things for AI, I think we could have that. And you could get that spooked from some earnings from some of these NVIDIAs of the world.
Yep.
I think the NASDAQ's poised to probably correct 15 or more.
Mm-hmm.
And then the part of the market that's kind of been left behind probably will fare better.
Yeah.
And that's kind of my opinion now. So I think correction in 2026.
Okay. Yeah. I wrote correction, yes. And there's a chance we even get 2, I think, because valuations are one piece, which you already talked about. The second one is we're heading into midterm election.
Oh, yeah. Which and typically is going to flip, probably.
Yep. And so you could get some volatility around, the late summer, early fall period when you get all the different, October surprise and all the fun stuff that happened in those large election years. So there could even be a second one there that's driven not so much from the market or fundamentals, but from uncertainty or expectations.
We didn't even talk, it's not even in our list, but we should talk about midterms. And historically speaking, and this would be my base case too, is that at least one, House or Senate, is probably going to flip back to the Democrats. It's a Republican across the board.
Very close margins.
Narrow margins.
Yes. So you're right. The high probability is that one of those 2 will
flip. And that's not an opinion. That's history, right?
Yeah, that's
history, that's typically what happens in midterms. I would not say that would be unlikely. It seems likely.
Especially when the House and Senate are controlled by the presidential party.
Yeah.
You usually see it flip midterm. Yeah.
So tariffs, that's been a discussion. Early this year, it was like at the beginning of April was when the Liberation Day happened and markets fell apart all the way to April 9th, which was the low. Tariffs have been the discussion. We've got some stability right now. We're bringing in actually a lot of tariff income, which is something that it was interesting. I was hearing on the news the other day. They were actually saying like it would be hard for a new administration, in 2028 to turn off this because of how much there is actually substantial billions of dollars coming in, 200 and some $billion coming in from tariff revenue. But anyway, we've got stability right now. There's at least deals with enough places that we're not flipping switches every single day on tariffs. The Supreme Court thus far has held up most of the tariffs at this point. I think that there will probably be some tariff discussion because that's just the way the president works right now, but it's not going to be the focus.
Yeah.
But it's going to be certainly continue out the rest of the year, but not the focus.
I said less tariffs, and I don't think it's going to be a massive change.
Yeah.
But I do think there are maybe some court rulings that may adjust kind of where and how much and how things are done. And I also think there may be some agreements that happen that help reduce some of that.
Yeah.
But I agree with you in that I don't think they're going away. I just think there may be a little less by the end of the year.
So the question I have for you, Josh, is what environment? So think about the macroeconomic environment we're in, maybe even the market environment we're in. So what environment are we in, and how should you think about it when you're looking at long-term investing?
Yeah. So long-term investing, you really ignore the noise of the short term. I mean, that good long-term investing doesn't care what happens in 2026. Those that do care, like if I'm making a big transition, retirement, those type of things, it matters a little more. But I'm thinking a little bit slower growth, pretty steady inflation, maybe creeping up a little bit from mine. Yours is maybe staying right where it's at. Rates coming down from those cuts. So what does that mean? I think similar to what we saw the last couple of years, our economy is poised in this type of environment to do well. Anywhere inflation in the low 3s, upper 2s is good for our economy.
As long as it's stable.
Yes, that's good. Rates are at a spot where we can grow, invest. Yep. Everything's poised to do well. I do think we will see some volatility in the market, which is normal. Every year you experience volatility like that. So what does that mean? If you have cash, you could wait for some sort of correction to put some more to work. If you've done that the last couple of years, you've missed a lot of growth waiting on those things. And then just be mindful that long-term money, don't try to time anything.
No.
Short-term money, you could be a little more strategic about when do I take money out, when things are going well, when I put money in, when things are down.
Right.
But other than that, the long-term objective should not change.
Correct. Yeah, I think when I think of what environment we're in, from a macroeconomic standpoint, it's like we're getting mixed signals.
Yeah.
So the labor market is certainly pointing more late cycle, right? We've got unemployment ticking up. A lot of that's...
We didn't talk about that at all.
We didn't either. We're at, 4.6% unemployment, which is the highest it's been since 2021, 2020, whatever we got out of COVID. So it's the highest we've seen in some time. But that's actually not necessarily from people losing their jobs as much as the labor market size changing. Yeah. A lot of that's
more
been due
retirees,
to more retirees
entering the market.
And immigration changes have obviously changed a lot right now. So labor pool size is different. So it's not like there are layoffs, of course, but that's not what's driving unemployment higher. It's labor pool size. So I actually think the labor market is still weakening, still slowing, but it's better than a headline change would show. Okay. But that's one area that feels more late cycle. So the labor market feels late cycle, but there are certain areas that are certainly picking up speed. I think we could be turning a corner in manufacturing, and that's been down for a couple of years now. Well, that is being buoyed by things like AI investment and things like that. So that's certainly seeming a little bit earlier cycle, or at least mid-cycle. So it's a mixed picture of what we're seeing. Do we see a correction for the markets potentially? But do we see a recession from an economic standpoint? I don't see that.
A few signals.
It seems very unlikely you'll get a recession. And one of the reasons for that is it's a bifurcated economy. It's a K-shaped economy. That's what everyone's talking about right now, but it's true. Those who are doing well are continuing to spend so much money that they are making up for the people that aren't making as much money and spending as much money. And the economy is not just staying afloat, but actually growing. And we just had third quarter GDP. The second revision came in. way above all expectations.
Really blew those expectations.
Blew those expectations out of the water. And I think price stability and stuff like that is certainly going to help. Throw in a couple rate cuts, and I think it could be, I'm not seeing any signs of a recession, but it's certainly, again, mixed signal on what we're looking at there. And as far as market cycles go, it's hard to say your early cycle when you've had a bull market coming out of 2020 or 2022, I guess, for that matter, coming out of the 2022 bear market lows. So you're on the third full year of a really good run.
Yep.
And markets are stretched and multiples are elevated. However, a lot of these things are not showing signs of slowing down. And in fact, people like to freak out about multiples, and I'm one who looks at multiples all the time. The market is actually trading
multiple times.
Multiple times.
Yes.
The market's trading at similar multiples, and in some cases cheaper than it was a year ago. And yet the market's was 18% higher on a total return basis in 2025. So where did that come from? Earnings growth.
Yep.
It was not
that's
multiple.
The best place to grow is earnings growth.
And that's what drives stocks over the long term.
Yes.
It was not multiples and multiple expansion that drove the market higher in 2025. It was earnings growth. So that's a sustainable year. Do you get that in 2026? You have to have the earnings growth because where multiples are, you really can't go much higher without having the earnings growth accompany it, and that's where the uncertainty is right now.
Yep. Have you ever felt overwhelmed by the complexities of managing your wealth? You're not alone. At Hixon Zuercher Capital Management, we specialize in helping affluent families and individuals navigate the complex challenges of managing their finances. Wealth management is all about combining thoughtful financial planning with active investment management to help you reach your goals. Our process is designed to guide you toward what truly matters because we believe wealth isn't the destination. It's a vehicle for something much more meaningful in your life. Achieving your dreams requires careful planning, smart decision-making, and access to high-quality investments. That's where we come in. We understand that complex financial situations call for deep expertise in investing, tax strategies, and retirement planning. But our approach goes beyond that. We integrate your financial goals with your core values, helping you visualize the possibilities your wealth can create for a secure future. If you're ready to take the next step, visit hzcapital.com/start to see if we'd fit into your needs and to schedule a call with us. Again, that's hzcapital.com/start. Now let's get back to today's episode.
So let's talk about themes. Themes for 2026. So AI has been the big theme.
That, yes.
Coming out of this was all the way from the end of 2022. ChatGPT was launched. Everyone uses it every day, right? Or now Gemini is becoming quite popular.
Gemini is popular.
Mr. Samsung
Google
guy. But yeah, AI, innovation, growth. The question is, does the AI theme, some people call it a bubble. I'm not willing to say that yet. Does the AI theme have more room to run?
I think so. I think, again, you mentioned it, is you had kind of in the tech area, the first expansion from this new technology.
Right.
And now it's sort of seeping into other areas, manufacturing. There's other spots that are saying, hey, we could take and utilize this technology for our own benefits.
Totally.
And you're seeing it kind of ripple through other areas. And I think that's where you're going to see most of the growth is tech companies have already kind of started to price in everything they can do.
Oh, yeah.
But you're going to get that ripple effect where other people are asking and demanding more need and use, which will help those tech companies still. But in general, it's going to be the manufacturers and distributors and those areas where they said, hey, we can innovate and make this more efficient.
Yeah. Oh, yeah.
And I think that's where you're going to see most of it.
So it's like you read my paper before We really didn't.
It's like you've told me this.
It's like I've told you this before. No, my thought was, does the AI theme have room to run? Yes, but it's more from the next level is what I think, right? So first level that you think of when you think of tech, when you think of AI, is NVIDIA, right? It's the chips, it's Broadcom, it's AMD, it's all these AI chip manufacturers. Well, then, they, like you said, they are pretty much how much more growth could be priced into what they're going to do. It's not. They are capped out.
Yep.
Their capacity is capped out for that matter. They can't even make anymore. But what's the next level that's going to lead that theme higher is going to be the picks and shovels is what I call it, right? This is the things that are implementing and that are the infrastructure behind AI. And that's where I think hardware, data centers, logistics, servers.
Yep.
These sort of things are going to be where the next leg's higher. So the market leaders, what's going to perform best? What's going to perform worst? I think that it's going to be a broadening theme in 2026. And I probably said this last year if anybody would have asked me, and it didn't work out. And there's some things that they don't work out that way. But I do think that we're going to have that broadening theme. And I think that you're probably going to have decent returns from a lot of these AI leaders. But I think if you're looking for what's going to do best, it's going to be some of these catch-up plays, things that have gotten left behind and things that are supporting the AI theme. And what's going to perform worst? Well, it's a couple interesting things that could do poorly. There's a lot of risk in the consumer. The high-end consumer is doing very well. The low-end consumer is not. But the valuations are so bad on those, or attractive in terms of beat down, that they actually could do okay. So it's really hard to find something that can perform the worst. But it's really what could do the least good. Because I think we're kind of in a Goldilocks environment right now. And, I don't know. That's a tough one to call.
I wrote down for doing well, and this is something that came from you, but financials, if the Fed does continue to cut rates.
Steepening yield curve.
And then the change in the yield curve, I think financials are poised to do well.
So we just finished equities, we finished fixed income, we talked about commodities, we kind of have some ideas of our thoughts on what's going to happen in 2026. But let's talk about what to do.
Yeah.
Because it's easy to put a bunch of numbers out there and say what we think assets are going to do.
And these are not predictions. These are things that you should do.
Yeah, these are things these are recommendations.
Actions, yes.
Those were not recommendations. Those are opinions and thoughts. These are actions. These are recommendations. So what should people do heading into 2026?
Yeah. The first thing is, and this is not a 2026 thing.
This is evergreen.
Yeah. This is just straight ignore the headlines. Stick to your long-term plan. So you created a plan for getting to your goals. Don't let the scary headlines in the short term disrupt what your plan was long term. When do you adjust your plan? When things change on where you want to go or how you're going to get there.
Oh, yeah.
So job change, things like that. That's when you need to review your plan, not just because something on the news shows up. Right. And so that's the difference. Ignore the headlines. That plan, by the way, does need looked at periodically.
Sure.
Is my savings rate still the same? You're not changing or reacting to the environment.
Yeah.
You're changing or adjusting based on your circumstance.
So that, having a good plan, which is where we would obviously recommend working with someone professional, working with an advisor who knows and has a whole plan laid out for you that's really been tested through any scenario that the market can throw their way. That's really going to help an investor have a lot of confidence.
Yes.
Who knows what's going to happen this year? Yeah. Because you know what I do know? All those predictions I just gave you, I would say that most of them are going to be very wrong.
Yeah.
And most of yours are going to be very wrong.
Very
and
wrong.
Most of every single financial professional's estimates are going to be wrong.
Yep.
And that's just the nature of predictions. Because what we do know, what we can be certain about is that uncertainty will prevail. And we're going to see, something's going to happen this year that we can't predict.
Yes.
And that's okay. Because
that's
happened every year.
Go back
forever.
And look at our episode. We did not predict COVID.
Right.
That's
true.
A big surprise. We didn't predict the drawdown and the high inflation in 2022.
Yeah.
Those things will happen. And in the end, you stick to your plan and you're going to end up where you need to be if you have a good plan and you follow the things you need to do.
You can make little changes along the way, but your long-term plan is going to be intact. So talk to your advisor, double check, make sure. This is a great reminder that going into a new year, look at your asset allocation. Look at your, overall needs for return and risk profile and everything, and make sure that that's in check. And then
savings rate,
yeah. Delete the app.
Yeah, and then just
because again, like you said, the noise is going to be there, the news is going to be there.
Yep.
I'm not going to stop watching the news.
No,
but they should.
Well, or just when you watch it, just understand.
Yeah,
it's good.
It doesn't matter.
On, but it should not change your long-term
Absolutely. So, thank you for listening. Those are our very wrong estimates of
best guess we've got for 2026. But thank you for listening. If this episode was insightful for you, hit that subscribe button on whatever podcast player you're listening to so you don't miss an episode when they drop. Be sure to follow us on social media. You can put your estimates of what's going to happen in 2026 in the comments on those. We'd love to hear from you. And then if you're ready to, find out what we do at Hixon Zuercher Capital Management, we think we're pretty cool. We do some pretty unique stuff here. Head to hzcapital.com and check that out. And you can get show notes and free resources like the timeless principles of investing at thewealthmindsetshow.com. Otherwise, thanks for listening, and we'll see you next episode. Talk to you later.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hixon Zuercher Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hixon Zuercher Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hixon Zuercher Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.